Hello and welcome to Portfolio Matters. In today's Share Talk, we will be discussing the marine services company James Fisher Sons. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, Keith, let's hear about James Fisher.
Okay, first of all, thank you to James Battle, who has put me onto this company, which I'd previously never heard of. And we will be discussing it on our Discord channel, which everyone is welcome to join. Okay, so James Fisher Sons are a very well diversified marine engineering and services business. And our summary of this business is going to be that it's very acquisitive. It has bought lots and lots of very small marine businesses which are in a lot of disparate little sectors. And we would be concerned about the fact it's more a conglomerate than a coherent company. And to give you an example of the concerns, their 2020 results were heavily affected by impairments to two dive support vessels that they invested in 2019, and then in 2020 found they were underutilized and wrote them down by about 60% and are now thinking about selling them off, which, you know, they're thinking of selling them off now. And if you listen to the CEO, he's saying, well, he wonders whether James Fisher is the right owner of those vessels. Nothing has changed about the underlying markets in 2 years. So when they clearly didn't think it out properly. And, you know, what makes you worry about the controls they have in place over all these separate businesses. Now, the reason we're interested in it is that the shares remained 50% below their January 2020 levels. And actually, I think they had a pretty good 2020, all things considered. Revenues and profitability held up. It still made a profit last year before impairments, of which there are a few, and we'll go into it. But the shares are on a PE ratio of 16, and it's a medium-sized company with a few issues, and it's definitely in the value range. What is going to change the market perception of it and lift these shares? So, and as we go through this, you'll see that historically it has had actually quite strong revenue growth from purchasing all these businesses, but that revenue growth has not translated into earnings growth. Now, what is going to change going forward? And that is the big question. Okay, so this is the share price, and you can see that between 2010 and 2020, the share price actually did incredibly well. It went up about fourfold, but then it has since more than halved from January 2020 levels or late 2019 levels, and it remains depressed. And if we look at its history, and I've been through the RNSs, and frankly, we're not going to go through this in detail. All you need to know is that every single one of these is an acquisition. And it gives you an idea of how many acquisitions it's done and a general sense of the size of those acquisitions. So let's just pick a few at random. March 2014 acquires Defence Consulting Europe, a provider of specialist swimming delivery vehicles, for 3.7 million. So these basically military vehicles that deliver Marines, etc. And they've recently sold some of these to Asia. December 2017 requires EDS-HV, a supply of high voltage engineering services to the offshore industry for 9 million plus 5.6 million performance related. Then last one, 7th of August 2019, acquires Brazilian diving services provider Serviços Marítimos Continental for 7.5 million. So it's buying lots of these quite small marine businesses, which are really in disparate areas. So wind farms, diving, calibration systems, diver delivery systems for the defense. And going all the way back, actually, you'll see that it was a much more diversified business prior to 2012, and it was not actually just specializing in offshore. So in December 2012, they sold their railway engineering division to Hitachi. So since then, they've been moving more and more into offshore. Okay, let's talk through events in 2020. So in March 2020, COVID-19 update. Trading in the first 2 months of the year ahead of 2019. So everything's going well, but obviously then we get COVID. So it defers CapEx, instigates a hiring freeze, cuts salaries of all board members by 20%, suspends the dividend. Actually, eventually it cuts the dividend. Then in April, it places 400 staff on furlough and defers 20% of salary for further 800 staff. Half-year trading statement, July 2020. Revenues in Q2 down 18%, half-year revenues down 10%. No, not great. All employees but return to full salaries, but it's still reducing its debts, in part because it's cut the dividend. And then half-year results, profit down 20%, but it's still making a profit. You know, actually, I don't think that's too bad. Debt reduction, announces an 8p dividend. November, now the market takes this badly. Q3 is challenging with no improvement in trading. I mean, frankly, the world is in lockdown. I mean, what does everyone expect? Revenues down 17%, cutting selling, general and admin costs by 17%. As you will see when we go through the accounts, the selling, general and admin costs have massively increased over the years. And I think that's probably long overdue anyway. But they're still guiding for a decent profit. And then in April 2021, Q1 revenues down 15% on Q1 2020. But you remember that the first 2 months of 2020 were going quite well. And there's yet to be an uptick in the market. And obviously, we're still kind of in lockdown. We're hoping things are improving from now. Okay, so let's start talking about James Fisher. It has lots of divisions, and we're going to push through this all quite quickly. But showing these presentations of what each division does, I think you get an idea that it does lots of different disparate things. So inspection and monitoring, load cells, so stress monitors, stress rings, X-ray inspection, nuclear plant characterizations, geotechnical construction plants, hull stress monitors, and then lifting and handling, and you're talking about container weighting systems, lifting equipment, load shackles, winches and hoists, marine services. So ship-to-ship transfers is big, and we will talk about that later. Offshore support vessels, vessel chartering, and then mooring and fendering, making some pretty basic stuff like, tie-offs, quick release mooring, anchor chain monitors. And then this is nuclear, and they've got remote inspections, whole nuclear division, offshore support. Now, some of this, heat suppression, etc., offshore equipment, offshore pipelines, but things like artificial lift, that is specialist oil well engineering. And, you question why a marine services company has that, because that is not just marine. Oil companies need that wherever they, drill, depending on the specifics of the oil field. Shouldn't that be with an oil field services company? Submarine rescue, and they've had the contract with the Royal Navy for many years, I believe. And then subsea engineering, dive equipment. And this is remote operated vehicles, strain rings, launch and recovery, subsea engineering. There's a lot of stuff here and lots of different things. So let's try and get an idea of what they actually do by looking at some recent projects. And they have a very good website. And if you're interested, take a look. There's a quarterly magazine which shows, highlights a lot of their projects, which is really interesting. So this is for a wind farm, the Kraken project, and they're going to install a load of sensors to measure the tides and the wind, and so get an idea of when it is optimal to service, go out there, close the wind farm down and do the servicing. And this is interesting. So did you know that whenever they do serious offshore work, such as installing wind turbines, you have to protect the marine life from the noise by imposing a bubble curtain, and the bubble curtain deadens the noises, and it is mandated around the world, everywhere apart from in the UK apparently. So this is one of the James Fisher vessels blowing bubbles around this offshore wind farm installation in Taiwan last year. And their strain gauges are now being used in Norway on the fish farms to stop the cable snapping and the whole fish farm floating out to sea. And then they do a lot of modeling and sensor work, working out the wind flows for offshore turbines, etc. And one of their divisions does high pressure abrasive water cutting, which is used in the decommissioning of offshore rigs, and you can cut through the supports, etc., etc. And apparently it's substantially cheaper than traditional methods, and therefore they have been winning work. Now, one of the things they are interested in and looking to expand is ship-to-ship LNG transfer. Now, they do have a large existing general ship-to-ship transfer business, but they're excited by the possibilities of LNG transfer. Apparently that did well last year, and they're aiming to increase their global offering. And they do measuring, weight measuring systems for containers. This one is in New Zealand. And then offshore, they hook up oil rigs to power, etc. This is interesting. So they've had a business measuring the health status of bridges and buildings all around the world. And so the Abu Dhabi Louvre have commissioned Strainstall, which is one of their divisions, to fit a light temperature, humidity and vibration monitoring system inside the Abu Dhabi Louvre, which is quite impressive actually. And then earlier we were talking about their acquisition of EDS-HV, which stands for high voltage, and they have been involved in hooking up various offshore wind farms. And this one is the Triton Knoll offshore wind farm off the coast of Lincolnshire. And finally, this is their Brazilian subsea subsidiary, which operates underwater remote vehicles and generally has been used with the Petrobras, the big Brazilian offshore oil company. Okay, so I think you're hopefully getting an idea of essentially a conglomerate of small marine businesses. Now let's look at their results. Okay, so this is the 2020 results. Revenue was down, but actually still pretty respectable given all the disruption last year and the deferral of oil and gas investment, etc. Now, one thing you should be aware is it's a big international business and most of the sales are in US dollars. So strong sterling is going to be bad. Gross margins came down, but actually held up really very well. Actually, I think. Administrative costs were reduced by 17%. And the underlying operating profit came down, but still, you know, underlying, this is before impairments, 40.5 million. So I think actually this is pretty resilient in an extraordinary year. Then let's get on to their impairments and separately disclosed items. So the DSVs here, those are the diving support vessels, and we will go into that later. Now, the other big thing is the receivables. They wrote off 3 unpaid bills relating to projects in West Africa and Saudi Arabia. Now, if you listen to the Q&A after the results announcement, they talk about generally most of their work is done commissioned via the big oil companies, and these were exceptional, and this was done directly with the counterparties, and the management teams that were responsible for okaying this have been let go, apparently. And there was a question in the Q&A about why this was put through as an exceptional item rather than through the P&L, and it was because it is an exceptional item. Generally, they don't have impairments. They don't have to write off bad debts. And also they thought the performance of the marine support division was disappointing, and they are restructuring it and have put in new management, which is good. They've let 200 people go at an annualized saving of 8 million. Again, we look at the cash flow. Now, notice the cash flow, the payments into the pension. And those are actually really quite substantial when you look at, you know, underlying earnings. You know, 15% of earnings is going into the pension. The other thing to notice is they essentially invested at precisely the wrong time. So they invested in 2019, they invested 56 million in these 2 dive support vessels, and then essentially they've written off 33 million of it pretty much immediately in 2020. And they've continued to buy small businesses. Fathom is specialized in diver communication systems, but they paid down debt. You know, so debt over the year fell. So commendable. And net debt over EBITDA is 2.7 times. They have debts coming due in 2022, 162 million. Now, I really, frankly, in this interest rate environment, I can't see that being any problem to renegotiate or to roll over, frankly. Now, one thing I would bring to everyone's attention, though, is the working capital. You'll see that working capital fell substantially in 2020, and that will have flattered cash flow. So if work comes back in 2021, they're going to have to gear up again, and working capital will probably have to go back up, and that will consume cash. So you'd expect cash flow situation in 2021 to look worse. Going on to an operational review, you know, marine support, where they have restructured, is the standout bad one. So the revenues are down 20%, profits down 60, best part of 60%. Elsewhere, profits were down between 20 and 30%. And marine support, the revenues were lower as lots of oil and gas projects were deferred. So moving on to division by division. The dive support vessels were underutilized. So having invested in them, they found that actually one of them got no business at all, and the other one was only utilized 20 to 25 to 30% of the time. So massively disappointing. But, entirely understandable when oil hits minus $40. Lots of oil and gas projects were deferred, but offshore wind is a big sector here, and that is growing. So you'll see they didn't lose money prior to impairments, so not actually terrible. Now, Specialist Technical, they built the world's first 500-meter saturation diving system and delivered it during the year. I mean, who knew you could dive to 500 meters these days? Amazing. And then, we talked earlier about them buying these swimmer delivery vehicles. Well, they delivered 6 of them to Asia, growing. Hopefully that establishes a market. And nuclear, they're saying, was doing quite well under a new management team. Offshore oil, they are saying that they think this was the standout performance, because actually it was quite resilient in a very difficult market. Although you notice their division definitions are quite fluid, in that aquaculture seems to be an under offshore oil. So anyway, about bubble curtains, for example, they're doing offshore wind farms rather than oil as well. And they've got growing decommissioning activity. The pumps, which we've talked about, why have they got a specialist well completion division? Tank ships, which go around the UK delivering oil to harbours and fleets. 90% utilization rate, resilient, as you'd probably expect, although obviously small boats were probably, there was much less leisure boating activity last year, so it's entirely understandable that revenues were down. And they are undertaking a strategic review, and we will go into that a bit more, but anyway, that's a good thing. Understandably, given what we've seen, they have a complex organizational structure. They've got loads of disparate little niche businesses. And the question you have to ask is, have they managed to meld this into a coherent whole? And the diving support vessels does lead you to question that. So they're aiming to exit low margin businesses and to expand their core profitable businesses into more geographic areas. So they're planning to invest in LNG transfer, as we've discussed, invest in aquaculture, and invest in capturing flare gases, which hopefully will be a growing market, because a lot of offshore oil fields and gas fields flare excess methane, which is just total waste, and that should be captured. So current outlook, they have a capital markets day coming up in June, by the way. So they're saying trading is in line with expectations without necessarily saying what those expectations are. Okay, so let's go on to the diving support vessels. There are 2 diving support vessels, the Subtech Paladin and the Subtech Swordfish. They were bought and refurbished at the cost of 56 million in 2019. And then in 2020, utilization rates were very disappointing, and they wrote them down by 33 million. Now they're both up for sale. The Paladin, which is based in Lagos, had a utilization rate of 25 to 30% in 2020. So as of 11th of March, the Q&A, it was negotiating a long-term contract in a different location, and there's no idea when that starts. If it's successful, they haven't released an RNS or anything saying whether they won that contract. If it's successful, they'll reconsider the sale. and they won't sell in a fire sale. There are no desperate need to get rid of these. But the CEO in the Q&A was talking about how the revenues had proved to be much more volatile than they expected, and they wondered whether James Fisher was the correct home for these vehicles. I mean, they should have done that work before deciding to invest 56 million. That really suggests a lack of operational control or strategic thought. The Swordfish is based in Dubai, did no work at all in 2020, but it is just, they've signed a 3-year framework agreement with a tier 1 contractor, and they're anticipating it being put to work in April. They've also said currently there are no buyers, which you would expect given, you know, the operational history they've had. So let's have a look at them. This is the Paladin. So previously it was the Toysa Paladin. It's now the Subtech Paladin. This is the Swordfish, and they look pretty much identical with different paint jobs. And with the glories of the internet, we can track these down. So the Paladin, based in Lagos, has been moving around, but not much. It's been moving around in December, and then its last movement was in February. It's still in the Bight of Benin. So we don't know whether the new contract was successful, but we know that it was outside that area. So, well, one thing is certain is that it hasn't moved to a new destination yet. The Swordfish, good news, it's doing stuff. Having been totally quiet the whole of 2020, it is now moving in and out of Dubai. So presumably it is under charter. Now we now look to the historic numbers. Now, notice the revenue growth. Up until 2019, actually, revenue growth steady every year. Growth of 10% on average, maybe a bit more. But that really wasn't translating into increased operating profits. So in 2015, you had 440 million of revenue and 50 million of operating profit. By 2016, your revenue is, let's say, 50% higher, less, but rounding up, whereas your profits are only 10% higher. Not great. Good news is last year, operating cash flow was actually quite strong. And prior to 2019, they were steadily growing the dividend. Now, that's the drop in the 2019 dividend is because in 2020, they cancelled the end of year dividend for 2019. And they have a decent amount of debt. Now, let's look at this a bit more closely. You'll see strong revenue growth starting from 2011 right up in 2019. They're steadily buying businesses and growing the revenue, but that is very much offset by enormous increases selling general and administration expenses. So bottom line is they're not increasing profitability. They're increasing debt to pay for these businesses, but the new revenues are not profitable. Not terribly encouraging, actually. So going forward, what is going to be the catalyst to change that? Okay, so moving on, positives. Well, positives are that the market's recovering and its share price is depressed. It's about half what it was at the end of 2019. And so the market is not expecting and anticipating recovery in profits. There's an ongoing strategic review, which hopefully will look at tying all these disparate businesses into a coherent whole and concentrating on the profitable ones and letting go the less profitable ones. The debt levels are high but manageable, and it's well within its covenants, and I can't see any difficulty rolling over the debt. it has a diverse range of marine businesses, including lots of exposure to offshore wind and ship-to-ship transfers, etc., etc. So a downturn in one industry, such as oil and gas, will only partially affect it. And the growth in world trade, which we know is coming back, will have a positive effect on things such as the container weight measuring, etc., etc. Lots of the things it does. And I think it was pretty resilient in 2020, actually. You know, the drop in the revenues was quite creditable compared to a lot of other businesses whose share prices have recovered very strongly since. If we move on to the negatives, well, it is pretty indebted. Debt's debt to EBITDA of 2.7 times. Diving support vessels, you know, investing 56 million, then within a year writing them off and then deciding to sell them. That really does not make you look very clever. And it does not appear to have been well handled. As you've seen, it's got this diverse range of niche businesses. And, you know, it's not clear how they can cross-sell, frankly. And if they can't cross-sell, what's the point? Where are the synergies? It's also not well covered by analysts. The Investors Chronicle have got absolutely nothing on it. Research Tree have got nothing on it. And the oil and gas sector, to which it is heavily exposed, is suffering from low investment currently, and there has been as yet little uptick in offshore investment. Dividends were cut. We don't know when they'll come back. And above all, the PE ratio, even having halved now, the PE ratio is 16. And it seems, you know, not unreasonably valued. You know, in order to get the share price back up to where it was, you'd have to see a big expansion in the PE ratio. And does it justify that? And so historically, as we've said, historic revenue growth has just not produced earnings growth because of big increase in costs. And so what is going to be the catalyst that changes that? Okay, so in summary, I think this is interesting. It's got its problems, but there is potential upside there. But you have to believe going forward that they're going to be able to translate revenue growth into earnings growth in a way that they have been unable to before. Now, I have bought some, and actually I like the look of this because simply on a macro view that I think the marine services and offshore will be coming back, and that will deliver revenue growth. And if they can maintain margins, then their profits should come back. And hopefully the share price will start to appreciate again. Richard, your thoughts?
Thank you very much, Keith. Really interesting deep dive, if you'll pardon the pun, into James Fisher. What strikes me is when they seem to do some really clever stuff, some very interesting stuff, some pretty high tech and niche things, and they strike me as being a business that was wanted to grab everything, yes. And so rather than subcontracting out a piece of work to a specialist supplier, they wanted it for themselves, so they went and bought it. And okay, they probably thought they could make more money doing that. But in actual fact, what they've probably done is they haven't made any more money. They've simply removed the margin from the supplier that they purchased and instead spent it on management overheads to try and manage these businesses. And managing 30-odd small businesses, and they are all small, surely can't be efficient. I mean, I can't think of any way in which you can do that efficiently, especially when they're all doing different things. And yes. So there's no sort of cohesive activity that pulls them all together. I mean, if you're acquiring care homes, they're all doing care. There's not very much difference between them, but these are doing a lot of different things. So I think that's a problem for them, actually. I think that clearly they have done well during COVID. The share price plummet to 70p in November was unwarranted. As you say, they're valued at a PE of around 16, which I think seems fair for the time being. And when they do their business review, in my view, they need to be quite sweeping in terms of selling off non-core businesses and really focusing on the high margin business that they probably do extremely well.
Yeah.
And I think that's going to be offshore wind and power cabling. Looks like natural gas is a good one.
Mm.
The management of offshore wind services, and there are probably some others that they can do really well. But they need to, and then that needs to settle in, and they need to show that they're the high margin businesses that produce the profit.
Yeah.
And I think that process probably takes a couple of years.
Yeah.
And if it goes well, there will be a re-rating, one, in anticipation as it moves along, and two, once they've done it and they start showing the returns on it. So I think it's a very good, solid business, but it needs to do something fairly significant, I think, to ramp up the price
No,
and ramp up
I
the
agree with you. I
backing.
think that's very good comments, Richard. I mean, I think the thing is, I think it just needs to stop acquiring businesses for a while and actually do some work of integrating them all, looking at what it's got, concentrating on the high value bits and selling off the low value bits. Because as you say, when you look through the accounts, it just seems that any synergies they are getting are more than offset by increases in administration costs. So
Yeah,
actually profitability is not increasing. But
exactly.
yeah,
And I don't see how you can manage that number of small disparate businesses in a cost effective way.
yeah,
And they can sell them back, sell them to their management. There'll probably be a write-off of goodwill at some point, and then they have a good business relationship with the management. And they will be able to subcontract far more easily and not have to worry about
mm,
um, the foolish decisions such as buying dive vessels when clearly there's no need for them.
yeah, yeah.
So, but I think it's a really interesting one to go through, Keith. And don't get me wrong, I'm not writing it off by any means. I'm saying a good, hard strategic review that is done well with a sort of intellectual rigor in how best to
Mm.
maximise the profitability of this business will probably cause a significant increase in its profitability. And I don't
Yes.
think that's actually particularly difficult to do,
Mm.
but you have to have the right people do it.
Yeah. No, I agree with that. I think, there's clearly potential here. It just needs unlocking. You need to basically lift the margins and cut the G&A,
Yeah,
essentially.
yeah, absolutely. So it's very interesting, and thank you for putting such a lot of time into preparing it. And I love the deep dive into where are these dive vessels.
Isn't the
No pun
internet
intended.
wonderful?
I think that's really clever.
Okay, well, thank you to James Battle for bringing that to our attention and to everyone for watching. And I hope you'll press like and subscribe to the channel. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.